Hello, ladies and gentlemen. My name is Lowell Walters, and I want to talk to you today about using employee benefits to reduce costs. Now, I'm an attorney at Carlton Fields, and the focus of my practice is employee benefits. I wrote a general article about cost cutting and employee benefits, and you can access that article on carltonfields.com or send me an email at lwalters@carltonfields.com and ask for a copy. Now, whether your business is suffering financially because of the coronavirus or there's a general economic downturn, reducing costs can help your business stay afloat. One of the key points that's important to understand for our discussion today is that employee benefits can reduce employment taxes. Now, ordinary compensation and bonuses are subject to income taxes and employment taxes. And when I say employment taxes, I mean FICA, FUTA, Social Security, and Medicare. In general, these total about 15% of what you are paying to your employees, with about 7.5%, actually I think 7.45% is more accurate, coming out of the employee's share, and an equal percentage being paid by the employer. However, employer retirement plan contributions are not subject to these taxes, and employer contributions and employee cafeteria plan contributions for medical insurance purposes are not subject to these taxes also. So, to put this in perspective, a $1,000 payment to an employee will generally require the company to pay about $1,075, and the employee will only receive about $925. Potentially, the employee would actually receive less. I'm ignoring income taxes for the purposes of this example to keep things simple. But so there is that spread of taxes that you can avoid by using employee benefits. That same $1,000, if structured as an employer contribution to a profit-sharing plan or a 401k plan, only costs the employer $1,000, and the entire amount goes into the participant's account. Now, whenever the participant is eligible for in-service distributions or terminates employment, they can immediately withdraw that $1,000, which of course will subject those amounts to income taxes, but not employment taxes. If you use that $1,000 for medical insurance, it's exempt from employment taxes, and income taxes will not apply to it either. So it's even a better deal, better efficiency there. So one way that you can use employee benefits to eliminate the employment taxes is to take your bonus cash payments and convert them to employee benefit contributions. Simply make the bonus an employer retirement plan contribution, or make that bonus a reduction in the premium for someone's medical insurance. All right. This again will mean less cash outlay by the company because there are no employment taxes, but the employees will receive more for that same reason, no employment taxes. Now, before you were to go and implement something like this, if it interests you, the first thing you should do is speak to your health insurance or retirement plan testing advisors, the people who conduct your non-discrimination testing, because there are non-discrimination requirements, and this could affect your testing. Now, if you're thinking about structuring this as a retirement plan contribution, and it turns out that you have a non-discrimination problem, actually, I guess either way, if it turns out there is a non-discrimination problem, an alternative might be to structure your bonus, make it to a non-qualified deferred compensation plan. This will not avoid taxes. It won't avoid employment taxes. It won't avoid income taxes, but it will delay them. And taxes delayed is still a savings. All right. Another benefit to using a non-qualified plan to fund bonuses is that these amounts are generally unfunded accounts. So if someone were to qualify for, let's say, an $80,000 bonus, the company has to come up with $80,000 to give them $80,000 in cash. Of course, $80,000 minus the employment taxes, right? If you structure that within a non-qualified plan, that employee gets an $80,000 book account that is not immediately paid from company assets. In fact, the company could even add a vesting requirement. So, for example, the person might become entitled to that $80,000 bonus at the end of 2020, but they may need to stay employed by the company for another 3 years before they fully vest in those amounts. So there are definitely some attractive features to using non-qualified deferred compensation plans, even though they don't give you the same tax savings as your 401k and profit sharing plans. Now, getting back to eliminating employment taxes, early retirement incentives are another kind of cash payment that can be restructured as an employer retirement plan contribution. All right. These actually work especially well with non-highly compensated employees in 403B plans that permit post-severance contributions. 403B plans actually can make contributions for former employees for up to 5 years after they've terminated employment. So early retirement early retirement incentives, another opportunity to run this money through the retirement plan to get rid of employment taxes. Another way to eliminate employment taxes from amounts you would otherwise be paying to your employees is to convert unpaid leave, and I mean like unpaid sick leave, unpaid vacation, convert unpaid leave to employee benefit plan contributions. Unused amounts that you would normally maybe pay your employees for, they would be subject to income and employment taxes. And if you are the type of entity that allows unused leave to roll over to future years, that does delay taxation. But most entities that do that also end up paying the employee based on their rate of pay when they finally cash out that unused leave. And by that time, they may have gotten pay raises, so it can become actually more expensive to allow the rollover. However, if structured as an employer retirement plan contribution, then there are no employment taxes. And if structured as an employer contribution to health insurance or an employee health insurance contribution through a cafeteria plan, then there's no employment taxes and no income taxes as well. So those are key ways that you can help reduce some costs using your employee benefit plans. Now, something else to think about, and this is not so much reducing cost as increasing cash flow. All right. High costs can be offset if you have greater cash flow. And if right now you're experiencing, again, financial issues, you might be considering taking on investors, right? And then, of course, you have the issues of finding out what investors are interested, how it might change the environment, how it might change your role in the company. Well, the company actually can use its current 401k plan or can establish a new plan and have that plan be focused on investing in the company. And that would be called an employee stock ownership plan, or ESOP. Instead of your retirement plan, right? Instead of the company making contributions to a retirement plan and then the retirement plan investing in mutual funds, the 401k would actually take cash within the 401k and buy your company's stock. So the company actually receives cash from the 401k plan instead of putting cash into the 401k plan. And that generates capital for the company to expand, pay off debt, what have you. Now, if the company is interested in this option, there are things you need to assess before you go down this route too far. Many of us call it a feasibility study. And one of the things you'll need is an independent valuation of the company, an independent assessment of the company. And even though that's not something that we do, we can put you in touch with the right advisors if that's something that would interest you. And so again, you could contact or email me at lwalters@carltonfields.com for that. So hopefully I've given you a few ideas that you can think about to help you reduce your costs, or in one case, maybe not reduce your costs, but increase your cash flow. And it's a win-win that it also helps your employees. In future installments on this similar topic, I'm going to do a few segments on this. I'm going to discuss reducing employee benefit expenses in particular. If you have any questions or comments about this video, please share them. And if you have any ideas for future videos or have any general comments, please send me an email because I'd be interested in hearing from you. Thank you.